So the question is based on an article that they read where a market participant said that they think it's completely wrong for the markets to focus on something like the nominal twos and tens yield spread. So, you guys know we've been on about the yield spread for the last couple of months now. We inverted or went into negative territory, if you will, back in March, early parts of March. We re-steepened. Now we've re-inverted. It's a really, really important economic signal. And the article that somebody shared with me is basically somebody saying that what the markets are looking at is completely wrong, right? We can't look at the nominal spread between the 2-year yield and the 10-year yield. We actually need to look at the OIS spread, because that's a much more truer estimate of what the markets think of of where rates will go in the future. So I think to better explain this, we need to start with the basics, and the basics is understanding what drives the various parts of the yield curve. Now, you take a look at this chart. This is just the current yield curve for the United States, which basically tracks the yields across various maturities, starting at the 1 month, going back all the way to the 30-year bond yield. And it's important to understand what drives the short end, which is from the 1 month to the 2-year, the belly of the curve driven by something else, and then the long end, the 10s up to 30s, what drives that? Now, when we talk about the front end, the short end, so let's say we're comparing a 2-year yield to a 10-year yield, even a 5 to a 30, the front end is largely going to be driven by your actual short-term interest rates. So whatever the markets think the Fed is going to do between now and the next month from now, and 2 months from now, and 3 months from now, and 6 months from now, that'll be reflected in your yields for those maturities. Okay, so you can't, if the current federal funds rate, if that is trading at, if that's trading at, let's say, 3%, you can't expect your 1 month to be trading at a massive discount of 2.1%. You would expect that to try and match or get to as close as possible to that level. So your short end, with that in mind, is going to be largely driven and influenced by short-term interest rates. So we normally say that the front end, in that sense, is quote unquote controlled by the Fed, because wherever the short-term interest rate goes, that's where your front end will go. Now, in terms of the back end of the curve, when we take a look at things like the 10s and the 30s, that isn't driven by the short-term interest rate. That's basically driven by the market's expectations of what short-term interest rates will be in the future. So that means that the longer you go out the curve, the more your medium-term and longer-term growth and inflation expectations starts impacting those bond yields. Because think of your 10-year yield in a simplistic way as the market saying, I think the federal funds rate will be 2.7% in 10 years from now. Now, that's a very, very simplistic way of looking at a 10-year yield, but it explains, in a nutshell, what the markets are basically looking at when you take a look at a 10-year yield. And that's obviously on the nominal side. Now, it's not just your medium-term growth and inflation expectations that's embedded in that 10-year yield price or that or level, or that 30-year yield level. It's also something that we call your term premia. Now, term premia is just a very fancy market way of saying that's your added let's say payment, or your added incentive for being willing to hold on to risk for 10 years or 20 years or 30 years, right? So that is like the deal sweetener that needs to be added on top of something like a 10-year yield to entice investors to invest in something like a 10 or 20 or 30-year bond, because the further you go out your timeline, there's obviously more risk because there's more uncertainty. And we don't know what's going to happen in the next 2 months, not to say what's going to happen in the next 1 year or 10 years from now. So the term premium is basically just the additional incentive that investors will require to hold that bond for such a long time frame. So that is also baked into things like your nominal yields, right? So for some participants, they say that looking at something like the OIS spread, that's far more accurate and the only true measure that we need to use, because it doesn't include things like the term premium. It doesn't have that credit spread embedded in it. Now, even though that is true, and it does sound super smart and intuitive, I find the difference between the two, utterly useless, to say the least. And let me explain why. Looking at these charts of the 5s, 30s, and 2s, 10s, we have both the nominal in yellow and the OIS spread in green. Now, I'll let you be the judge of whether the one is more useful than the other just by looking at these two charts. So the idea of using the one and over the other is that the OIS is somehow better because you don't have the term premium. It's a truer measure of where the market's thinking rates will go. But is it really that better? That much better? I don't really think so. It's faster, absolutely. We can see that from the charts. Now, those that advocates of using the OIS, they love using examples like what happened back in 2018, where we had the 530s OIS inverting, but the nominals didn't. So they would say things like, that was the clue that the economy was going into a possible recession or going into a slowdown, but we didn't get that message from the just looking at the nominals. But obviously that forgets a couple of important points. The first one is that you don't just look at one part. You don't just look at one inversion. You look at the two tens as well. So you don't look at the 530s in isolation. We also look at the tens or the two tens as well. So if you look at the two tens, that already gave us a very similar picture compared to what we had with the 530s, even though the nominals never inverted. Now, the most important thing here to stress is that it tells you the same thing, right? Which we don't focus on the absolute level, i.e., did the 530s invert or not? Did we go below zero or not? That's not really the focus here. The focus is not on the absolute level. It's on the trajectory of the yield spread. It's on the slope. It's on the rate of change, if you will, of the move. That's the important thing. That's the message, right? So you don't suddenly wake up when your spread goes below zero. You should have been awake for the risk associated with the economy when that thing started to slope downward aggressively, and that obviously would have been reflected in the data. It would have been reflected in many other parts of the market as well. So what I would say to participants that say that the OIS is so much better, I don't think there's much advantage to be gained by looking at either the OIS or the nominals. The only real advantage that I could see from using the OIS above something like the nominal spread is that the OIS can be seen as a leading indicator for the nominals because it moves a little bit faster. So if you're using that advantage to potentially, if you're using it as a trigger, for example, to trade curve flatteners or steepeners, which is something that the vast majority of the retail crowd won't have access to anyway, then certainly that makes sense. And maybe if your broker offers you the ability to trade bonds, you could potentially use that to your advantage by basically buying twos and selling tens at the same time. But I would imagine that, just your trade cost associated with that would probably require you to get in at a really good entry spot. And furthermore, you would really have to see a massive amount of flattening or steepening in a short space of time to make it worth carrying that type of risk, which means, again, you're probably better off just trading one bond as opposed to trying to build some sort of synthetic spread to take advantage of the OIS spread that moves faster. So to summarize, I'm not saying that you shouldn't use the OIS spread. All I'm saying is that it's pretty useless claiming that the one is in some way superior to the other, because the advantage of the OIS over the nominal spread, in my opinion, in my honest and humble opinion, is very useless for the retail trader. If you are somebody that's running a massive bond book, a massive fixed income desk, then yes, you will probably want to be paying more attention to the OIS spreads. But then you'll probably have more sophisticated spreads and tools to monitor anyway, outside the scope of what the normal retail trader will look at anyway. So I think sometimes participants so desperately want to sound smarter than the next guy, and they try to desperately find things like this to try and make it seem like they have some secret source, like some secret hidden gem that no one else knows about, and this is the discovery that the markets have been waiting for, or something like that. Again, I'm not saying that the author of this article that says the OIS is better or it's incorrect, that was the term they used, is incorrect using the nominals. I'm not saying that they are one of those participants, but if they are trying to say that you shouldn't use nominals and the OIS is somehow this better thing, and keep in mind, you don't get access to OIS data, right? I got this data from Icon, which is a very, at least the pro version that we use, is a very expensive terminal. So Why would you pitch something like the secret massive, the secret formula OIS, and the retail crowd can't have access to it? So you're basically telling us, I'm looking at this magical thing and I've got the access to it. Unfortunately, you don't, so you don't get the benefit of using this. It's just it's silly in my opinion. So I know I'm going off on a bit of a tangent here, but I just find it so frustrating when participants try and force a specific idea on the retail crowd, and now everybody's trying to scramble, to get access to the OIS data. You don't need it to see what the spread is telling you. You can look at the normal nominal fives and 30s and twos and tens. You can look at it on TradingView like we do, and it'll give you the exact same story, right? It's flattening. Or it's inverted. That's the main story. The slope, the curve, the rate of change, the momentum with how we get there. That's what matters. Whether if you take a look at those two spreads again, the difference between these ones, you would have gained a massive, what's that, like 3 week advantage when the OIS inverted, and then like a month later you had the two stands, the nominal inverting already, or anyway, right? And you had them flat, and then this one re-steepen, and now both of them is inverted. I don't know. It's just a silly thing to say, in my opinion. So, to your question, no, I don't think you have to use the OIS spread to use the yield curve for what we use it for. And secondly, I don't think it's incorrect using the nominals at all. It's not just the fact that something is steepening or flattening that's in focus, right? It's where we are in the cycle, how that could potentially impact policy going forward, how that's going to impact various asset classes. And for me, just using the nominals will tell you all of that, will tell you everything. You don't need to have a OIS spread that basically tells you the same thing, but just moves a little bit faster and a little bit quicker than the other. So I hope that helps. If there's any additional clarity needed on this, don't hesitate to let me know.